So you're thinking about buying your first place in the Greater London, Ontario area, and your brain feels like a browser with too many tabs open. One tab has your parents saying, just buy something and hang on because that's what worked in the 1990s. Another tab has friends telling you to wait for the perfect interest rate. Then you hear about new rules, new accounts, new programs, and you were just trying to figure out where to start without making a huge mistake. If that sounds familiar, you are exactly who this video is for. You're watching Community Real Estate Group London and Area Living, where we share expert real estate tips and neighborhood insights to help you move forward with 100% confidence. In this video, I want to walk you through a simple roadmap for buying your first home here in Canada with a special focus on London and the surrounding small towns like Lucan, Thorndale, Exeter, Komoka, and St. Mary's. We will cover the money side, the strategy side, and the emotional side so you can make decisions that feel calm instead of chaotic. Let's start with the part that makes most first-time home buyers feel a bit stuck, which is the down payment and all the different accounts you hear about. Right now in Canada, you have a few powerful tools to help you save for that first purchase. The big one is the First Home Savings Account, the FHSA. Think of it as a dedicated lane on the highway that exists only for your first home. You can contribute each year. You get a tax deduction on those contributions. The money can grow inside the account. Then you pull it out for your down payment without paying tax on the withdrawal. It borrows the best features from an RRSP and a TFSA, but the whole purpose is that first purchase. Then there is the RRSP Homebuyers Plan. This one has been around longer, so many people already have money sitting there from past savings. You could pull a chunk out for your first home, but that money does have to be paid back over time. For some buyers, that is fine because it lets them top up what they already have in cash or in the FHSA. So the first real step is not scrolling listings. The first step is knowing exactly what you have now in savings, what you can realistically add over the next year or two, and how those different accounts can work together for you. Once you have that picture, then we'll talk about what the rules actually are. Take a simple example. Let's say you are looking at a $600,000 home in the London area or in one of the nearby towns. The minimum down payment is not 20%. The rule is 5% on the first $500,000, then 10% on the rest up to a certain cap. So in that $600,000 example, you would need $35,000 as a minimum down payment, not $120,000. That is a very different target to plan for. If you put less than 20%, your mortgage will be insured. That adds an insurance premium to your mortgage, but it often gives you a slightly better interest rate because the lender sees it as a lower risk. So lower down payment, a bit more borrowed, but often a bit less on the rate. Recently, the government also changed the rules for how high you can go with an insured mortgage and how long you can stretch out the payments as a first-time home buyer. Insured mortgages used to stop at a purchase price of $1 million. Now that ceiling is $1.5 million. That does not mean you should run to a $1.4 million home, especially if you are looking in places like Thorndale or Exeter, where you can often buy well without going anywhere near that number. What it does mean is that your budget is closer to that line. The minimum down payment can be much lower than it used to be. The other big shift is amortization. For years, if your mortgage was insured, you were capped at 25 years. Now, first-time home buyers with insured mortgages can go to 30 years. Stretching to 30 years lowers the monthly payment because you are spreading the principal out over more time. The trade-off is that you pay more interest over the life of the loan. For many first-time homebuyers, though, especially in a higher-cost environment, that extra breathing room each month matters more than the long-term total. This is where the emotional side sneaks in. You want to feel stable, not squeezed. If your budget feels tight before you even move in, every surprise bill will feel like a crisis. A slightly longer amortization can be the difference between lying awake at night running numbers in your head or feeling like, we have some margin, we can handle this. Now let's talk about how you actually build the down payment in a way that prepares you for home ownership instead of just leaving you completely exhausted. Imagine you are renting for $2,000 a month in the City of London right now. You sit down with a mortgage broker and you discover that a typical home that fits your need in a place like Komoka or Lucan would cost you closer to $3,000 a month once you own it. Instead of just saying, "Whoa, that's way too much," and walking away, you can use that difference as training. You keep paying your rent, but you pretend you already own the home. Every month you send that extra $1,000 into a high interest savings account or into your FHSA. You treat it like a non-negotiable bill payment. That does two things at once. It grows your down payment, and it proves to you that your future monthly payment is actually doable because you have already been living that way. At the same time, you look honestly at where your money goes. I'm not here to lecture you about skipping coffee. I love coffee. The latte is not what is stopping most people from buying. It's the combination of car payments, subscriptions, travel, little taps on the card that never really get tracked. When you attach those choices to a clear goal, suddenly it feels like sacrifice and more like a trade. You trade a trip this year for the ability to own a place in St. Mary's that lets you walk to the river every evening. You trade a brand new car for a simpler vehicle so you can buy a home with a yard where your beautiful kids can play. That is the kind of math that actually motivates people. Once you have a sense of the down payment and the monthly number you can handle, the next big piece is pre-approval. Think of pre-approval as your boarding pass. Until you have it in your hand, you are still in the airport lobby guessing which flights you might be able to afford. A good mortgage broker or banker will look at your income, your debts, your credit history, and your down payment. They do not just give you a single number. They help you understand how that number changes if you buy a condo in the city, a townhouse in Exeter, or a detached home just outside London. This is also where the stress test comes into play. In Canada, you are qualified at a higher rate than the one that you will actually get. The whole point is to protect you from rate changes. It feels harsh in the moment, but when rates move, you are often glad that your lender focused on the number that you could prove to be able to handle. Then there is the fixed versus variable decision. You can look at charts all day, but in the end, the right choice is the one that lets you sleep. If you wake up at 3 in the morning worrying about payments jumping around, a fixed rate may be worth a slight premium. If you are more comfortable with some movement because you believe rates will trend down over a certain amount of time, variable rate may make sense. The key is that you understand the trade-offs instead of just picking whatever a friend mentioned at the last barbecue. Once you have your pre-approval in place and you know your comfort zone, then we get to the part that most people picture when they think about buying: walking through homes. This is where emotions spike. You see a kitchen that feels like the one you grew up in, or a backyard that would be perfect for a dog, and suddenly it is hard to even think straight. So on our team, we use a very simple rating system. After every showing, we ask buyers to rate the home out of 10. But there is one rule. You are not allowed to pick the safe middle. You cannot hover in the mushy zone. If a home is a 6 or lower, we let it go. If it feels like an 8, we ask what small changes would nudge it higher once you paint, move your furniture in, or update a few finishes. If it feels like a 9, we really slow everything down and possibly talk about strategy, because that is usually a home worth chatting more about. That little exercise forces you to be honest with yourself. It also prevents you from waking up a month after closing and wondering why you spent so much money on a home that was always just fine. When you do find the home that really fits, we move into the offer stage. At that point, the paperwork looks intimidating, but the core pieces are very straightforward. There is the price you offer. There is the deposit that shows the seller that you are a serious buyer. There is the closing date, which is the day you actually get the keys. Then there are conditions that protect you as a buyer. Typical conditions include financing, a home inspection, and in the case of a condo, a review of the status certificate by your lawyer. Each condition gives you a short window of time to confirm that everything checks out. It is for your benefit. All these conditions are for your benefit. If something major comes up that you are not comfortable with, you can step back while keeping your deposit safe. The goal is not to make the deal feel fragile. The goal is to make sure that when those conditions are removed, you feel solid. Last, we look past the purchase price and talk about the true monthly cost of owning. Mortgage payments are only one part. In London or in the small towns around it, you will also have property taxes, home insurance, and utilities. If you buy a condo, you will have a monthly condo fee, but you lose some of the surprise repair costs. If you buy a freehold home in a place like Thorndale or Lucan, you may save on fees, but you also take on things like a future roof replacement or a new furnace eventually. When we work through this with clients, most of the anxiety drops. Even if the number is big, at least the number is real. You can plan for real. So let me pull this all together for you. Buying your first home in the Greater London area right now is not about exact timing or getting the perfect timing in place or guessing the perfect interest rate. It is about understanding the rules, using the tools that exist for first-time home buyers, building a realistic down payment plan, and then shopping with a clear head instead of a totally overwhelmed heart. Picture two versions of yourself a few years from today. In one version, you are still renting, still scrolling listings, still saying one day, but never really putting a plan on paper. In the other version, you are unlocking the door to a small bungalow in Exeter or a townhome in Komoka or a condo in London that actually suits the way that you live. You know what your payments are. You know why you chose the mortgage you chose. You know how you got there. Our job is to help you move forward that second version with a little drama as possible. If you even just starting to wonder whether buying in the Greater London area or in one of the small nearby towns might make sense for you, please reach out. We can walk you through numbers, talk about the different communities, and help you build a plan, all the while fully educating you that matches your life, not anyone else's timeline. We want to thank you for watching. If you found this video helpful, please like, comment, and share. And don't forget to subscribe to Community Real Estate Group London and Area Living for more expert real estate tips and neighborhood insights. Are you ready to take the next step? Visit us at communityrealestategroup.ca. We're here to guide you every step of the way.